back to Weekend Bite. We're now joined by William Huston, Chief Investment Officer of Bay Street Capital Holdings. William, thanks for being here today.
Thank you.
So inflation's likely not transient. It's going to stay here for a while with the Fed continuing its hikes. In this environment, alternative investments can prove to be an inflationary and recessionary hedge. Are there particular asset classes or alternatives that you feel could benefit?
Thanks. I really like the real estate sector, especially the luxury travel space. We spoke about hotels earlier and more how they're more affected by the ins and outs of certain types of travel. In the luxury market, though, you've got a much more illiquid asset. You're able to get higher rents on a night-to-night basis. And in terms of what we're seeing with the interest rates, yes, they've come down, which is a great sign for today. We're seeing the market positively respond to that, but prices are remaining intact. We're not seeing a big discount in the price points at properties that are much more illiquid, especially in the travel destination space. So I'm really excited about that opportunity.
So when you mention luxury travel and hotels and things of that nature, given the declines that we're seeing in consumer discretionary spending, which year to date is down nearly 30% on the heels of recessionary fears, how do you think that the luxury travel space will fare overall? How are consumers supposed to afford this type of discretionary spending?
So to your point, discretionary spending is down. So what I think is happening as a result of COVID is people are being more particular with how they travel. So if a family is going to go to Universal Studios, for example, instead of staying in a hotel where they're going to spend $600-700 a night, they're going to splurge a little bit. They'll look on an Airbnb, VRBO, or they'll look for some sort of private listing where they can spend about the same or slightly more and have their own private residence. They're going to be a little more safety there. There's going to be more space for them. And what they're giving up in the amenities of the hotel, they're gaining in a property that's going to be significantly nicer for their family to stay in. So although the discretionary spending is lower, my point is that people are still going to decide how they're going to spend their time. And on average, they're only going to travel 12 to 14 days. And because of that, I think that they're going to be more particular with how they spend that money.
With mortgage rates that are climbing at historically fast rates, what does this mean for housing and the rental market in general? And are you seeing any type of slowdown in the luxury real estate market?
So the interest rates came down today from 5.7 to 5.3, which is good. And again, houses are staying intact. Now, certain areas are still overvalued. So there's certain markets where the housing prices are out of control. But there are certain areas, especially when we speak about destination travel, where there's always going to be foot traffic to these areas. There are always going to be places where people go for their vacation time. They're not just like suburban areas that have seen an influx of people that have moved as a result of COVID. And in those areas, we've not seen any sort of major discount as it pertains to nightly rates or rents or even purchase prices, even as interest rates were coming up. There was no real movement in terms of the prices coming down. Prices have slowed down, and I think they will start to normalize over time. But I don't see any sort of scenario where the prices of those sorts of properties will actually start declining.
William, thanks for taking the time to join us today. William Huston, Chief Investment Officer of Bay Street Capital Holdings.
Thank you.